It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. I'm going to do something today I haven't done for a while. I get asked this question. I've talked about so many different financial things and big picture things and political stuff that affects our money lately because there's been so much that's been going on. But I get asked often, sometimes it kind of gets away from what is your personal bank? This is the Your Personal Bank Show. Today I'm going to go back to the basics. And, if you've heard this before, that's great. Could be a good refresher. This is actually going to be a good show that I'm going to encourage you to pass on to somebody who maybe's not been introduced to this concept. And that, by the way, this was the original impetus of why I started started speaking. First of all, speaking around the country to educate people. And then later on the radio, my impetus to educate people that there's a better way to think about your money in terms of growing. And it's called positive arbitrage. And it's creating a positive cash flow on your money. Most people are not doing that. Banks do. A lot of wealthy individuals and corporate finance boards and things like that use this tool quite extensively. But most Americans, the average Americans, do not. So, and most of them aren't even introduced to the idea, and that's one of the big questions I get all the time, which I'll touch on a little later. Why is my financial person not brought this to my attention? In most cases, they were never educated on this either. I wasn't until I got involved in the banking world. But anyway, my point is, this can revolutionize, this can enhance your financial position dramatically. And so I'm going to explain what is your personal bank. And again, I encourage you to pass this on to anyone you think may have an interest. But first of all, what is your personal bank? It's basically a financial concept that strategically integrates tools from the banking and insurance industry. And the goal is to grow your money, continue to have growth on your funds, even after you've spent or used those monies for other purposes. Now, when I say that to a lot of people, they get a little confused, and I'm going to explain it. It's a very simple concept. It's not complicated at all. You'll see, and you'll see shortly. But I want you to understand, it's a powerful but simple concept that can dramatically enhance your financial future, like I said. Now, before I jump into all that, I just want to say, I don't share a lot about my background. You might hear it a little bit on the commercials and all, but to give you a little bit more background about myself and how I came about this, and I'll jump right in how it works. I've been in the financial industry over 25 years. I'm an entrepreneur. I've actually owned 4 businesses. I've owned a retail business, a real estate investment company, a service company, and of course, this financial agency. And so I'm an entrepreneur at heart, and I'm in the process. I'm on the board of a bank, an FDIC insured bank. We're in the process of trying to start a bank. And that's a long, drawn-out process, but I'm trying to start my 5th business, along with a team, obviously. And so I'm an entrepreneur at heart. My wife calls me a serial entrepreneur. So I'm not your typical financial person. I really, truly am an entrepreneur, and I look at this from an entrepreneurial lens. And when I first viewed this, that's exactly how I saw it. I happen to be a financial guy, but I have an entrepreneur's heart. And so I started speaking around the country for 7 or 8 years prior to COVID. Teaching, meeting with investor groups, educating them on this concept on how it can enhance their return on their investments. And it went over tremendously well, so much so I had to pull back on my speaking engagements because, gosh, I was getting to the point I was never home on the weekends because I did a lot of weekend workshops and things, right? And then when the radio thing came along, it gave me the opportunity to talk to another audience. Just fell into my lap. I was not looking for this. I actually hesitated at first. Because of the time commitment. And that was my big concern because I had a business, an agency. Our company had over 5,000 clients at the time. I had something like 15 employees and about 20 sales staff. My hands were full, and I was traveling the country speaking and educating. And I also, at one point, was teaching a college-accredited financial literacy course. I mean, my hands were full. My plate was full, as you might put it. But I couldn't pass up on the radio opportunity because it allowed me to open up and share this amazing concept with another audience. Of course, about a year later, COVID hit. All the speaking engagements went away, and turns out to be truly a blessing. This turned out to be quite the blessing because businesses kept growing, right? And by the way, I just want you to know that it's from those experiences that I had as an entrepreneur, financial person, bank board members, where I was able to kind of put all these things together and put together this your personal bank concept. And what it is there's two steps. And what we do is we set up a high cash value policy that's designed to maximize cash growth, tax-favored cash growth. And then the second step is we set up a bank line of credit using the cash in the policy as collateral for the loan. Now, when I say policy, this is the interesting part. A lot of people, it's not the type of policy most people are familiar with. In fact, gosh, maybe 1 or 2% of the people I run into typically have ever seen anything like this. You know, if again in the institutional investors, like I said, on bank board meetings, we talk about it all the time. You talk about institutional investors, family offices, folks with 10 million liquid and above, typically, things like that. It's very common. High income earners, executive bonus plans. This is all very common. But in the average, what Wall Street calls the retail world, it's very uncommon. And that's a big reason why I was doing the speaking and why I do the radio show, to educate, get the word out. We set up what's called a high cash value policy, and it's designed to maximize cash growth and liquidity while minimizing the death benefit. This is the opposite purpose of how most people view and use life insurance. And you know what I'm talking about. Most people, when they're purchasing life insurance, they want to pay the least amount of money to get the biggest death benefit, right? I mean, we've all done that. And that's fine. That's perfectly, I have some of that too. But that's what I call a death benefit protection policy. Yes, they call it life insurance, but let's be real. It's really death benefit protection. I mean, how is it life insurance? The person who's insured, if you're the like myself, I'm the dad and the husband and the breadwinner of the family. If something happens to me, I have life insurance on myself, I'll never see the money. It's for my loved ones, right? Or business partners or whatever, right? So it's really death benefit protection. Now, they don't call it that because that just doesn't sound as nice, right? But that's what it is. And look, if you have death benefit protection needs, as I do with my family and my business, you should have some of that. And I do. But this is not what I'm talking about. In fact, if somebody misses the whole point, I'm going to tell you right now, right up front, where they miss it and why they miss it. See, a lot of people, again, get hung up on that term insurance, or they have their view, they have a mindset about what it can be used for. They think of it as a single purpose use. And I've even heard terms like buy term, invest the rest, and all that. And again, that just denies the fact of the wide variety of abilities of what these policies can do depending on how they're structured. Okay? A lot of people view insurance as an expense and they don't want to bill. They stop listening and they miss the whole point. Again, this is not what I'm talking about. Folks, there's something like over 800 insurance companies in the United States. About 40 of them or so are what we call mutually owned companies. And many of you have heard of many of the names, and they're common names like Mutual of Omaha, Northwest Mutual, and Mass Mutual, and et cetera. What's important about these mutual companies is that there's no stockholders. In other words, if you have a stock insurance company, they have stockholders and policy owners, and whatever dividends they earn, dividends or profits of the company, right, they have to split amongst the stockholders and the policy owners. Well, a mutual has no stockholders. The policy owners, in effect, own the company, right? Do you want to share profits with the stockholders or not? You want half the profits or all of them? That's one that pretty much easy. You don't want to share dividends. That's a no-brainer, right? Or interest or whatever. Out of those, there's about 15, give or take, that have paid a dividend for over 100 years and never missed. That means they've paid dividends through both world wars, the Great Depression. I mean, you name it. That's powerful. We even have some of the companies have been paying dividends. I talk about this often in the radio show, literally since before the Civil War. Okay, that's a super powerful. Now, out of those, there's 3 of them that have been paying dividends of 5.75 or higher. We have companies paying 5.75 to 6% dividends even in today's low interest rate environment, for the last 25 plus years. And again, I've never missed a dividend since literally before the Civil War. But all 3 of these companies I'm talking about. I'll show you the charts of all the top dividend payers if you contact me at yourpersonalbank.com or call me at toll-free 866-268-4422. And by the way, you'll get to me, okay? So I'll be happy to talk to you about that. Out of those 3, there's one. Now, that can vary depending on certain times or when you're listening to the show. that's going to have the lowest fees, which means they have the most cash. Lower fees equals more cash to you, right? Again, our goal here is really quite simple. We want to maximize cash and minimize death benefit. And if I had a visual I could show you, I know this is radio, but if I had a visual, I always tell people, envision a teeter-totter, right? Put cash on one side of the teeter-totter and death benefit on the other. And again, most people, when they're purchasing life insurance, they want to pay the least amount of cash for the biggest death benefit. And again, that's a death benefit protection tool, strictly. What we do is the opposite. We flip the teeter-totter the other way. We maximize the cash, and we minimize the death benefit. By the way, depending on the type of policy we're setting up and the amount of funds we're talking about, we can reduce that death benefit, and those maximize the cash, by 50 to 85%. Now, if we're increasing the cash by 50 to 85% right out the gate, we're reducing the cost of insurance by 50 to 85% right out the gate, right? See, that's one of the most common questions I get all the time. Well, what's the cost of insurance? Well, if you're reducing the death benefit by 50 to 85%, you're reducing the overall cost of insurance by that same 50 to 85%, right? What ends up happening is then the costs of doing this become very, very competitive to other investment tools that are out there that people are familiar with, like mutual funds and various other tools. That's one of the biggest misconceptions that are out there. And many financial advisors even will attack, if you will, or misunderstand and challenge. But again, they're thinking about the traditional use of life insurance. Again, where's the risk to the insurance company? The death benefit or cash? If you have a high death benefit, and you get hit by an ice cream truck, as I always say, they got to stroke a big check to somebody, right? Well, if we reduce that death benefit significantly, again, cut it 50 to 85%, and we're going to cut as much as the tax laws allow, by the way, we're reducing the risk to the insurance company, reducing the cost of insurance, reducing the fees, all of it. Okay? This makes it very, very competitive, okay, compared to other tools, financial tools that are out there. And again, that's a very common misconception I run into all the time. Lastly, agent commissions are based on death benefit. So again, if you're cutting the death benefit by 50 to 80%, also cutting the agent commission by that same amount, which is another reason why some agents are not willing to share this. Not all, but there's some, okay? Now, that's how the insurance side works. In the next segment, I'm really encourage you to stay tuned. I'm going to talk to you about how the bank line of credit works and how the two work together to create positive arbitrage on money you spend. So really, I'm going to encourage you, don't miss this.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we're going back to the basics. We are talking about what is your personal bank. Again, as I stated in the first segment, I've been talking so much about the things that are going on currently and the bigger picture of economics and our money that some of this has kind of got pushed off on the wayside, but this truly is a powerful tool that you can use to increase your rates of return, create positive arbitrage. And if you missed the first segment, again, the personal bank concept is very simple, actually, where it's a two-step process. We're using a high cash value policy to generate cash, to maximize growth on your money, whether that's dividends or index credits, either way. Again, the goal is to grow your money, minimize the death benefit, maximize cash, right? Grow your money as much as possible. And then the second step is set up a bank line of credit using the cash and the policy as collateral when you access the funds and gain positive arbitrage between the two. The first segment I talked about the insurance policy, how that works. So if you missed it, I'm going to encourage you to go to yourpersonalbank.com. You can listen to any of the previously recorded shows. Check it out. Call me if you want more information. Call me at toll-free 866-268-4422. Now I'm going to talk about the bank line of credit, the second piece. Okay. So again, we've set up the policy to earn dividends, to earn cash, to earn index credits. Well, whatever we've done to set it up, we've maximized the cash. The money's going to grow. And by the way, we can fund those in chunks all at once up front. We can fund it over time, monthly, yearly, annual, quarterly, annually, whatever. Doesn't matter. Depends on your situation. Okay. You're going to have 50 to 85% of your money available liquid day one. Okay. Again, depending on what you're funding and the size of the account and all that stuff. The next step is we set up a bank line of credit. There are several banks out there that offer lines of credit. I've identified about a 10 or so around the country. This is a very specialized area of lending. You're not going to be able to go to your local bank and say, hey, I want to do this type of loan. It doesn't exist. It's a specialized, but I've identified pretty much all the players around the country, and I've identified what I consider the three best in terms of the best rates, the best service, all that kind of good stuff, right? And any of these, there's no loan fees, okay? Interest is only charged when you access the funds, and there's no fees, no points, nothing to set it up. These are completely and totally free to establish, all right? You only get charged interest when you access the funds. And by the way, when you do access the funds, the interest could be a tax deduction if it's used for business purposes, by the way. We'll get into that further. The cash in the policy is used as collateral used for collateral for the bank. And the interest rate charged is typically less than the dividends or interest earned in the policy. Here's where the power of this comes together. So as I stated in the last segment, we have companies that have been paying dividends every single year and have never missed, literally since before the Civil War. Tons of cash reserves, A+ rated. These are name companies. If I mention the names, you'll know exactly who they are. If you contact me at yourpersonalbank.com or toll free 866-268-4422, I'll be happy to share with you what these companies are and their history and track record. We've got and they've been paying these 5, 7, 5, 6% dividends plus for the last 25 plus years, well positioned to continue to do that many years forward. So we set up our money to grow the dividends or the interest credits. We can do index, S&P 500 and other indexes depending on your risk tolerance and that kind of stuff. So you can get more potential upside with no downside risk. So again, a double-digit growth on good years, market years, and no losses on down years. We can do that. So, or a mix of the two, by the way. So again, our goal here is to grow your money, whichever mix makes the most sense for you. Then we set up the bank line of credit. Now, using the dividend payers, those are the steady Eddie dividend payers. It's much easier because we know exactly what they do because they have a consistent track record and history for over a century. If you're earning, here's a quick and simple question I ask everybody. If you put your money into one of these accounts and it's earning 5, 7, 5, 6% dividends, by the way, with guarantees, insured, and tax-free, those are all powerful. And then if you leave it there, it's going to grow, right? That's pretty straightforward. Each and every year compound, right? When you decide to access the funds, if you then access it through the bank line, and the banks are charging between 3 and 3.95% interest, just so you know, depending on the size of the account. If your money's growing at 5.75 to 6%, and you're getting charged between 3 and 3.95% when you access the funds, folks, what's your money doing? And the answer, just about everybody gets this. Well, your money's still growing, or some of it, because you're keeping the difference. And I'm like, bingo, exactly. That's it. You got it. You're keeping the difference. In most cases, most clients I work with, the difference is 2.5% to 3% per year, every year for the rest of your life. Now, that may not sound like a lot, but in 10 years, that's an extra 25, 30% more money in your pocket that you wouldn't have gotten any other way. Because here's the takeaway. And folks, here's the big takeaway. So if you're doing something, I'm going to tell you, wait 20 seconds, because that's all it's going to take for me to share this with you. And if there's one thing I want you to take away from this whole presentation, this discussion, the takeaway is this. That 2.5%, 3% positive arbitrage, the difference of what you get of the dividends you're getting paid versus the interest you're getting charged, the difference of what you're getting to keep. Folks, it's on money you spent. That's the power of your personal bank. Where else can you earn interest on money you spent? I have made that statement for close to a decade. I have spoken in front of literally thousands of investors throughout the country for 7 or 8 years prior to COVID. And now on the radio for the last 2.5, 3 years. At this point, I don't even know how many hundreds of thousands of listeners, literally, over that time. Geez, there's more than that each week, actually, on the various stations that this show is aired on and all the online options and all that. And I've made this statement over and over again. Where else can you earn interest on money you spent? And nobody, to date has come up with a solution other than this. And if I knew about it, I'd be talking about that on the radio, wouldn't I? I'm kind of a big mouth that way. Those of you that know me know this about me. If I find something that's really awesome, I just can't keep my mouth shut. I'm going to share it with everybody I know. That's just who I am. I guess that's what makes me. That's what makes me who I am. How's that? And I relish that. I enjoy that. I enjoy educating people and helping people understand. You earn interest. You keep the difference. So you're earning more than you're getting charged on dollars you've allocated elsewhere or spent elsewhere. What can you do with that money? Folks, anything you want. It's your money. It's tax-free. There's no tax implications. There's no penalties. There's no nothing. You want to take that money and pay some bills? Knock out some debt? Go for it. I love doing that with people who have debt. Because I've gone into situations where I've wiped out people's debt and literally have seen differences of even $1,000, $2,000, $3,000 a month, positive cash flow monthly into their pocket because we wiped out a bunch of debt that they were paying on different bills, credit cards, car loans, mortgages, you name it, right? That's fun. And by the way, there's two ways of making more money. You can make more or spend less, right? Paying less debt is one of them. Oh, how about reducing taxes? That one's fun. I do that a lot too, okay? It puts more money in your pocket. How about going out and buying something, and maybe you were going to finance it, but now instead you use this tool, you pay for it, and even if you do finance it, you reduce the cost of borrowing. If you're going to buy a car and pay 5% interest, for example, and you got 2.5% positive arbitrage by using this tool, you cut the cost of borrowing in half. You pay half the interest you were going to pay for that car. How's that? In the next segment, because I'm running out of time here, I'm going to talk about what you can do for investments and how you can increase your rate of return on investments. So don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank. Today we're going back to the basics and we're talking about what is your personal bank. Now in the first segment it's a two-step process. We set up a high cash value policy to maximize growth. We want to maximize dividends or interest credits, whatever that may be, guaranteed, with safety, tax-free. We want our money to grow. We maximize cash, minimize death benefit to the limits allowed by law. So again, we want to grow our money. Then the second step is we set up a bank line of credit when we decide to access funds from the account. Again, we'll just leave it there. So it's going to grow, compound every year, insured with guarantees and tax-free. When we access it through a bank line of credit. And the banks charge historically, by the way, they've done that every month for the last 40 years, except 2 months, by the way, charge less in interest than you're earning. You keep the difference. And again, it's on funds when you access the money and use it. When you spend the dollars, in other words, you earn interest on money you spent. Now, if you want to understand more of how that works and you missed it, go to yourpersonalbank.com, go to the first two segments, and I explained in depth how the two different pieces work, the policy along with the bank line, to create the positive arbitrage. What I was talking about or discussing here at the end of the last segment was what can you do with the money? And the answer is anything you want. You can pay debt off, which eliminates debt. Done that for a lot of people. That's a lot of fun. You can purchase items, like particularly big ticket items that maybe you finance, like a car or whatever. You can reduce the cost of borrowing. I have had people use this as a tool to reduce the cost of borrowing on a mortgage and literally wiped out the interest on their mortgage 100%. How would you like to buy a house, get a mortgage, you're getting charged interest by the mortgage lender, of course. Using this tool, the positive arbitrage you receive and earn is as much or more than the interest you're getting charged. So in essence, the net is it's wiping out the interest cost to you. So you're just buying the house for the price of the house. No interest. Folks, I've been doing that for years with a lot of people, and it's saving them over a 30-year fixed mortgage, hundreds of thousands of dollars of interest. Look, if you're going to do a mortgage like that, you're going to pay the interest, right? Would you rather see that interest go to a lender's pocket or your own? You see my point? This can make a huge, huge financial difference for people. What about investors? A lot of listeners are, of course, are investors. And one of the misconceptions that I see a lot of investors make until they talk to me, and I'm going to encourage you to do so, contact me at toll-free 866-268-4422 or yourpersonalbank.com for more info, is they're looking at, well, I have these investments that I already have, and they start thinking, should I do that versus should I do this? And I tell them, no, you're missing the whole point. Do both. Do both. In other words, this is icing on the cake. This 2.5-3% positive arbitrage that people are getting is over and above in addition to your returns on your current investments. Let me explain. Let's say you invest in the stock market. Let's say your average rate of return is 7%. I don't know what it is. It doesn't matter. Or you invest in real estate or crypto or precious metals or a business or any classic cars or whatever. I don't care. Guns. It doesn't matter. Whatever asset you invest in, let's say your return is 7%. Let's make it better. Let's say your return is 10% per year annually, consistently over time. All right? You have a choice. You can continue to invest in your investment, whatever that may be. And if your rate of return averages 10%, so be it. Okay. But you could also instead take the money through here, take your money, fund it into a policy to earn dividends or interest credits, then access it through the bank line of credit and go invest in your asset, whatever that is, and receive the positive arbitrage. Again, most cases, 2.5 to 3%. What happens? If your rate of return is 10%, by using this tool, you will increase your rate of return to 12.5 to 13% annually, every single year for the rest of your life. You'll also get some tax benefits here and some guarantees and some safety and consistency. Look, some people make the mistakes of saying 2.5, 3% is not a whole lot of money. I hear that sometimes. No. This is on top of what you're earning. Would you rather make 10% or would you rather make 12 or 13? Folks, that's a 20 to 30% increase on your rate of return. Increase your rate of return 20, 30% every year, and you do that for a decade without compounding. You have 20, 30% more money, don't you? Folks, this is huge. Compounding makes it bigger. You take a business and you add 20 to 30% profits to its bottom line. That will fundamentally, dramatically change just about any business you can think of. Household finances and investments are the same thing. You do this for a decade or 2 or 3 or more even, and look out. Your increase on your rate of return, the total amount of money you have, is phenomenal. Now, I'm going to share in the next segment, so my last segment here, I'm going to share with you some other things you can do to really, what can you do to turbocharge this and actually fundamentally change your financial future, your life, and the next generation. Stay tuned to the next segment. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. Today we are discussing what is your personal bank. We're going back to the basics, and if you missed any of the other parts about how it works, I'm going to encourage you to go to yourpersonalbank.com, listen to the previous segments. In fact, you can listen to any of the previously recorded shows anytime you want. This is a show that if you have somebody you think may be interested, it'd be a great one to send to them too, by the way. Again, it's a 2-step process. We set up a high cash value policy designed to maximize cash, period, with guarantees, tax-free, consistent. We want to grow our money, minimize death benefits. It's the opposite of what most people use insurance for. Then the second step, again, is something most people are not familiar with. Institutional investors are. The average retail investor, as Wall Street calls them, that's somebody less than 10 million liquid, typically, as a rule of thumb, has not been introduced to this or approached to this idea. Typically, I find very few people who have. That's why I do the radio show. That's why I spoke around the country for years. And again, this is the realm of institutional investors, but it's very effective for anyone, for any size, frankly. Okay? So my point is, we set up this policy that's fundamentally, we do a rider that fundamentally changes the policy to how most people, not how most people are familiar with it, again, to grow cash, grow your money. Then we set up a bank line of credit using the cash in the policy as collateral for the loan. if you leave the money there, it's just going to grow. Like I said, with guarantees, insured, tax-free, compound. 5.75%, 6% dividends. We have companies been paying that since literally before the Civil War, never missed any single year. That's a long time, folks. And then when you do decide to access the funds for whatever reason, again, tax-free, the banks charge less than you earn dividend-wise. And historically, I mentioned this in the previous segment, over the last 40 years, every single month, the amounts of dividends you were earning, for example, versus the interest you were charged was more, except for 2 months of the last 40 years. And those 2 months happened to be equal, so you weren't hurt. So positive arbitrage, knows the difference of what you get to keep when you spend the money, has been there every single month for the last 40 years, except the 2 months, like I said, that they were equal. So my point is this has been a long-term, consistent, effective tool to create positive arbitrage and reduce taxes, reduce market risk, and is highly inflation resistant because if interest rates go up, dividends go up with it. It's highly correlated. So it's a great inflation. So if you're worried about taxes, you're worried about inflation, you'd like to make your money go farther, create positive arbitrage, your personal bank is definitely something you want to look into. Call me at toll-free 866-268-4422 or yourpersonalbank.com. Now, one of the common questions I get is, what's the cost of insurance? First of all, that question demonstrates that you're still thinking about the traditional use of insurance, which is frankly a death benefit protection policy. Far too many people have a very narrow view, frankly, a view of that's the only thing insurance can do is be a death benefit protection tool, and they just totally miss it. There's so many other things that insurance can accomplish, and high income earners and high net worth individuals understand that and use it on a regular basis. In fact, I've helped many folks over the years who are selling businesses for multi-millions of dollars, offset tremendous amount of taxes currently and forward, perfectly legally, using insurance, folks. That's one of the main tools, or pass it on to the next generation. These are the tools that are used very commonly by the wealthy, by institutional investors. But the other thing is about the cost of insurance and fees and things. As I stated in the first segment, if you missed it, we reduced right off the gate, depending on the case, situation, and how we're funding it, 50 to 85% of the death benefit. We're reducing it by 50 to 85% right out the gate, first date, every year. Maximizing the cash. We're pouring all that into cash. Well, by reducing the death benefit by 50 to 85%, we're reducing the total cost of insurance by 50 to 85% right out the gate. That would be like going to your, similar comparison would be like going to your financial advisor and saying, hey, can you cut my fees by 50 to 85%? I think we know the answer most of us would get if we asked that question, right? Okay? So it's funny how so many financial people, that's the first place they attack because they think it's high fees or whatever, the high cost of insurance. They try to attack, not realizing the way we structure it. That's the strength. That's one of the strengths of this tool, your personal bank tool. So again, try that one out. I'm going to tell you right out, our commissions, by the way, are dropped by 50 to 85% accordingly because of how we're structuring it. And so that becomes another reason why some advisors are not willing to discuss this type of tool, just so you know. Not saying all, but some. Now, the other thing that comes about a lot of times, people misunderstanding or whatever, is they often think, well, on my health or my age, they understand we're minimizing the death benefit, but there still is one, so I still got to qualify for something. And my age or health won't allow me to do it. I'm too old or too unhealthy. Folks, I've had people successfully do this up through age 79. The numbers still worked. Okay? Because again, we're not trying to go for a whole bunch of death benefit. We're doing the opposite. We're trying to go for a whole bunch of cash and dividends and growth and tax-free growth and more control of your money, more access to your money. We're wanting just minimizing that death benefit as little as possible, which makes it easier to qualify for and less. Okay? Health-wise, if you're you can be below average health, and the numbers work just fine. Now, yes, if you had a situation where you've had major health issues, what do we do then? No problem. We set up what we call family legacies, and that's often what we do when somebody's too unhealthy or truly is like in their 80s plus. We've set up many of these where you can pass on wealth to the next generation on a tax-free basis. We set up these policies so that you, the person who controls it is the owner. The one who funds it is the owner. They control the money. They get the money, the dividends, the tax-free growth, access to the money, the positive arbitrage, everything we've been talking about. And then, but child or grandchild or some other relative or whatever, business associate or whatever is the insured. So what ends up happening is then this policy gets passed usually through a trust or other entity like an LLC, gets passed to the next generation. This is how the wealthy pass wealth from one generation to the next, folks, using trusts and entities like LLCs and corporations, oftentimes. And you then now pass this, all the money you've put into it, all the tax-free growth you've accumulated and compounded, excuse me, continues through the next generation. Now, my point is really simple. Think about compound growth over decades. What kind of financial impact does that do? Folks, that changes families. And there's a term called leapfrogging, and I'll educate you on what this is. This is something that's commonly used by wealthy families. In other words, to keep wealth in a family multi-generational. What happens often is the parents or grandparents, when a child is born in the families, they set up one of these policies to maximize cash growth on a tax-free basis, compound with guarantees. And over that kid's lifetime, let's say 80 to 90 years, right? You know, average American lives to close to 80 to 90 years, right? What do you think the compound interest is on that time frame? It's incredible. The thing is, typically, again, the parents or grandparents fund it in the early years of the child's life, and then when that child becomes of age, then oftentimes they then take over. They transfer ownership to them on a tax-free basis, and now that child who's now an adult and is responsible continues funding this thing and growing compound interest money and positive arbitrage and all that stuff for the rest of their life. And the whole idea is the grandparents, let's say, are taking care of themselves. There's a chunk of money there for them in the next 2 generations. You know, I often ask grandparents this. I'll ask them this question. I said, have you ever thought about, you know, charitable giving? And many, many grandparents have. And I'll say, well, correct me if I'm wrong, but most of the options you've looked at basically involve giving up, for the most part, giving up control of your money. And the answer overwhelmingly is yes. And I say, look, if I could show you how to fund something where it would grow, you have guarantees, tax-free, you have access to at least 50% of your money day one or more, and you could pass it on to the next generations tax-free, but maintain control during your lifetime, would you be interested? And most of them are all ears. That is what your personal bank does. See, again, if you lose control of your money, what most grandparents are concerned about is they might need that money if they have some serious health issues or something. And by the way, built into all these policies are living benefits which take care of long-term care type of expenses if they need them. If you don't need them, you didn't pay extra for it. It's just built in. And if you do need it, the money's there. And I think that's the best long-term care protection you can have, because if you need it, you got it. And if you don't, you didn't pay for it. So what could be better than that? So it kills several birds with one stone is what I'm trying to say. So what I'm going to say is it's a paradigm shift in thinking about your money, certainly. Some people need to get over their misconceptions about what insurance can do, because it can do an awful lot of things. It can accomplish a lot of things, far more than just invest, buy term, and invest the rest. That's just a very, very narrow view of insurance, frankly. Okay? It can grow cash. It's grown cash dividends for well over a century, consistently, every single year, tax-free. You can grow your money tax-free, access it tax-free, and pass it on to your heirs tax-free. Folks, of course you have to set it up and operate it correctly, which I'll teach you how to do. It's very simple. But if you're concerned about future tax rates, this is something you need to look into. Call me at toll-free 866-268-4422 or yourpersonalbank.com. It's highly interest rate sensitive. So if inflation continues to rise, like I talked about in the last show, we're seeing all-time high increases of inflation, or since the 1970s at least, dividend rates are highly correlated to interest rates. Interest rates tend to go up in inflationary cycles. Stocks and things like that tend to go down, don't they? Obviously. Look, this is a great tool for that. Could be one of your best investments. Great diversification, if nothing else. Non-correlated asset. If you're heavily invested in the stock market, for example, or real estate, there's no doubt those have had an unprecedented historic run over the last decade or so, largely in part because of the easy monetary policies of the Federal Reserve, which is starting to change. They're tapering purchases. They'll probably have to start raising interest rates, certainly as inflation rates continue to climb. In other words, folks, our economy, our situation that we've had over the past decade probably will be much different in the next decade. So you have to adjust accordingly. And your personal bank can be a tremendous diversification tool. It can reduce your taxes. It can help offset inflation. Okay? It can reduce market risk. It can, it can cover expenses for long-term care. And it can pass on monies to the next generations. Well, grow money for yourself on and access to tax-free basis, but also pass it on to the next generations tax-free. Again, if you think taxes are going to go up, call me at 866-268-4422 or yourpersonalbank.com. Look, I'm not trying to beg anybody to contact me. I have never been busier, frankly. So, and I assume, I've been in this business 25 years. This is my third rodeo in terms of economic cycles. I've seen it before. I think from an inflation standpoint, this one's this is going to be far worse than anything I've seen in my adult lifetime. Not since I was a kid, when it was 1970s, where I saw the effects of inflation. But I understand what it does. I saw it as a kid. I grew up on a farm. I saw farm equipment on the road with a sign to the bank saying, just take it, I can't afford to keep it. I saw that stuff. I lived in a farming community growing up. So I get it. My point is, I'm going to be probably busier than I've ever been in my career. I'm not happy about it because I don't think it's good for most Americans, and I don't think it's good for America, but it is what it is. So if you want to learn more about how this can dramatically enhance your financial future, reduce taxes, offset inflation, gain more control of your money, and get positive arbitrage, and pass on monies to the next generation tax-free basis, call me at 866-268-4422 or yourpersonalbank.com.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.